Welcome to the Dealmaking with Laura DiFrancesco podcast. I'm Laura DiFrancesco, your host. We're talking all about mergers and acquisitions, buying and selling small businesses, as well as corporate law. We are taking our experience closing over $10 billion of transactions since founding Dean Street Law 5 years ago, and my experience being an M&A and corporate attorney for over a decade and making it accessible to you as an entrepreneur. I hope that this helps you in navigating the complex world of mergers and acquisitions. And also, we're always happy to be a resource for you here at Dean Street Law. You can always apply to work with us through our complimentary consultations linked in our show notes. And a huge shout out and thank you to everyone who's subscribed and left us a 5-star review. If you haven't yet, be sure to subscribe and also leave us a 5-star review. It's one of the best ways to support us as a small business. And also be sure to share with your friends and colleagues on social media, through text, email, or however is easiest. It means the world to us that you're supporting our content and helps us make more to support you in your journey. Welcome back to another episode of the Dealmaking with Laura DiFrancesco podcast. I'm really excited today to be talking about negotiating the purchase price and seller note. This is ultimately so critical for the entire success of your deal-making process. If you're new to buying or selling a business, whether you're on the buy side or on the sell side, there are so many different things to consider when negotiating the purchase price. And it really, truly can make or break your success in the overall transaction. It's where you drive your return on investment, your base cost within the business. And on the sell side, it is your exit. It is your nest egg that you've been building for your career. So whether you're buying or selling a business, negotiating the purchase price and seller note can be so critically important in the process. And I oftentimes see that this really goes sideways quickly, especially when folks aren't really well versed in the process. So I want to talk about a few things overall to consider before you even get into the process. First off is perspective. So oftentimes the parties think that they're on the opposite side of the fence of each other. If you're on a football field, every yard closer to the other person's end goal is the more that the other person's losing. And that could be a really challenging way to look at it. Yes, in some instances that's correct, but in a lot of instances it's actually not. So when you're thinking about purchase price, it can seem like every dollar traded is a win or loss in either person's favor. But really, when you think about the fact that both parties would actually agree that the business is valued higher in different situations, and both parties can agree that the business would be valued lower in different situations as well. And really, the parties are aligned in that they don't know what the future holds. A lot of the buyers are buying the business based on the potential earnings of the business, the future earnings of the business, as evidenced by the past earnings of the business. Inherently, there's a lot of unknown there. And so the buyers are very concerned about overpaying for something when it's not going to perform in the way that it is expected to perform because of certain risks. And then the sellers, on the other hand, are thinking of what they've put into the business, what they have invested in the business, that this is a huge opportunity for them to live off of and retire off of. And for both parties, they can agree that, if you're talking about a $5 million business, and if that business is making X amount, it's going to be actually valued at a certain amount. But if it's making double, it's certainly going to be valued more, right? So while there are things like multiples, which is where you value the business based on a certain industry standard multiple, based on the size of the business, sophisticatedness of the business, risk profile of the business, and that's your multiple, and that multiple may be paid on seller's discretionary earnings, EBITDA, earnings before interest, tax, depreciation, and amortization, or it may be on revenue or something like that. So there are different ways that you would consider what that multiple is based on what it is that it is multiplying. So there's a lot of different ways to value a business, and asset value is another valuation. We're actually going to be talking about asset heavy businesses in our next episode. So asset valuation is also a part of that as well. So when you're thinking about valuation, it can be so easy to fall into the trap that you're on opposite sides of each other. And in fact, you're not. And when you can align and say our goal is to have a valuation that feels good for the both of us, that makes sense for the both of us, that is mutually beneficial, we are able to move beyond purchase price and get into some of the more nuanced discussions in your negotiations. The other biggest mistake that people make is thinking that purchase price is everything, and it's not. There are so many different economic impacts that deal terms have. Part of the reason why I want to talk about seller notes is because seller notes directly impacts both the buyer, what they're paying for the business, and the seller, what they're getting out of the business. And this purchase price, everybody hangs their hat on this purchase price so much, but when you have the conversation holistically at the beginning of a negotiation, when you're working on the letter of intent to discuss what the economic drivers are, you're creating a holistic picture of what the buyer is paying post-closing, at closing, and what the seller is receiving at closing and thereafter. So you really have to think holistically that purchase price is not the end-all be-all. And when you bring other economic elements into the conversation, if one is so important to the parties, you can massage the others so that you have holistically a economic picture that is mutually beneficial to the buyer and seller leading up to closing, through your negotiations, as you're papering the documents, and post-closing as well. So don't get stuck on one particular economic element. Remember that there are many at play, and it is very bad idea to leave too many of them too late in the conversations. You have to think about, when you're negotiating an LOI, whether it's a competitive situation that you have to just get the minimum viable terms necessary to create a foundation for your transactions, or do you have the time to negotiate some of the more nuanced economic elements that will deeply influence both parties? One of the things that people forget to think about is whether that purchase price includes working capital, which is the current assets less current liabilities, the engine of the business. So when you're thinking about valuation, and valuation of a car is a really simple example. When you're thinking about a car and its value, it is different whether that car includes its engine. If it doesn't include its engine, it has a different value than if it does include its engine. And that's what working capital is. Working capital is the cash flow within the business, and it is the engine of the business. A buyer can certainly finance that working capital through a lender, absolutely, but it may come at a higher cost. And so when you're thinking about the interest rates and seller financing terms of your seller notes, that can bridge purchase price discrepancies, because most of the time seller notes are at 1 or 2 basis points below what a loan would be. And when you're thinking about that, in this current economic environment, in this current interest rate environment, that's usually very attractive to sellers and a great opportunity for buyers. The wonderful opportunity for sellers is that the more allocation of the purchase price that they take in a seller note, the more that they are able to defer their tax consequences related to that income. So that's a great opportunity for sellers. In addition, it repurposes their capital immediately and they are able to earn. And as long as there's appropriate amounts of security, it's not a incredible amount of risk, probably less risky than the stock exchange, but perhaps more risky than real estate. Typically, it has more return on their investment than real estate though as well. So when a seller is thinking about how much they want to lend, in that they're thinking about the amount of security that they receive. Most of the time, it's going to be a second priority. But if they have a strong desire to push out their tax liability and minimize their tax liability, they could be the primary lender, in which case they may take a significantly higher security position than typical as a seller note because they want to defer their tax consequences. But when you think about that, your purchase price is a number, but when you think about actually what it means in terms of total payments, especially in terms of the seller note, that number grows considerably. And so allocating more of the purchase price to the seller note can be a great mechanism for improving the seller's post-closing position. They're earning more, they're taking more out of the deal because of the interest they're able to earn. And for the buyer, that deal is then costing them less. And so when you're thinking more about the entire economic picture, you can really see how the parties can begin to be better aligned in their discussion of purchase price, seller notes, and the economic terms of the deal overall. There's a lot to be won when you both are able to find what's mutually beneficial. This is one of the key reasons why having a great legal team saves you money. When you succeed on the structure, you win directly to your bottom line. It directly impacts the buyer and seller's bottom line when you have good representation and can understand the impacts of these things, because it's not just that purchase price number. It is what is the actual take home for the buyer and the seller after the payment of interest and payment over time and everything like that, including lease payments and the transition period between the buyer and seller, where the seller might be providing employment services or consulting services. All of these are going to impact the economics of the deal overall. And when you have all these conversations, including taxation up front, it can provide a really strong foundation for the transaction overall. Let's talk about a couple of more specifics in the purchase price fundamentals around the basic components of a purchase price. So the purchase price may have an entirely fixed component, an entirely flexible component, but most purchase prices are going to have a mix of fixed and flexible components. The fixed portion is oftentimes what the parties agree the value is. That's where it's easy to agree what the value is. It's clear based on the assets, based on the income. This is definitely what the value of the business is. Businesses are different than real estate, though. There's so many variable aspects to them, whether it be customer concentration or recurring payments or whatnot, that there's risk, and that risk tends to impact the purchase price. And so when you have elements of risk that are impacting the purchase price, that creates variability of the opinions between the parties of what it's worth, then you have the ability to address those discrepancies through the variable aspects of the purchase price. This may be through an earnout, a variable seller note, oftentimes called a forgivable seller note, but for tax reasons, we prefer to call it a variable seller note, and other types of adjustments such as working capital adjustments or similar. So those different components can be structured in a way to address deal risk. Where is the deal risk in this specific transaction is the question that you and your attorney are going to be working on, deciding, and how can we present these terms in a way that would be mutually beneficial. We can both agree that, hey, if sales double because you stay on for a year and are really focused on growing the business, then yes, it would have this valuation. We can agree on that. So most of the time, some type of earnout, and the difference between whether you would use an earnout or a variable seller note, aka forgivable seller note, is whether or not you're using an SBA loan. Currently, as of the date of recording, the SBA does not allow purchase price adjustments post-closing, such as an earnout. Depends on the SBA lender. Some of them will not even allow a working capital adjustment. Most of them will allow a working capital adjustment true-up post-closing. So the SBA has the minimum standard, and then the lenders adopt their own interpretation and usually include more requirements in addition to that. So when you're thinking about that in terms of how can I bridge that purchase price gap, those variable elements will be a great solution. I have a great blog posts that I've done on this previously that we can link in the show notes. And when you're thinking of an earnout or a variable seller note, you're going to tie it to that risk that you see within the business that both of the parties typically can agree upon in the business if there's a super high customer concentration or if sale or revenue have been all over the place, and how can you decide really what that base number to use in your multiple will be, because there have been all of these ups and downs. So if there's a lot of variability or concentration risk or something else in revenue, or even if the parties are just having a trouble agreeing on what that true value of the business is, minimum value of the business is, these can be great solutions. And so that is going to decide how you have your variability determined. And we'll talk about that in a little bit of detail in our further conversations. When it comes to navigating corporate law, entrepreneurship, and managing small businesses, experience matters. Dean Street Law is a boutique corporate firm specializing in mergers and acquisitions and additional focus in real estate, commercial transactions, finance, and corporate governance. With over $10 billion in deals closed, Dean Street Law has extensive experience representing hundreds of clients in thousands of transactions, from small businesses to Fortune 500 companies. Whether you need startup guidance or advice on closing multi-million or multi-billion-dollar deals, we're your trusted partner every step of the way. Visit deanstreetlaw.com in the show notes to schedule a complimentary consultation. Different purchase price structures will make things more attractive to the buyer versus the seller, where the seller has a lower fixed element to the purchase price. That's going to be more attractive, obviously, because it's less risk for them that the business won't perform to the valuation post-closing. Of course, the opposite is true on the sell side. The higher fixed amount that they can get, usually the more comfortable a seller is, because this is their nest egg. With that said, the more that you can align on conversations of what the goals of the parties are, the better you're able to create a structure that makes the most sense for the parties. If the seller really wants the highest valuation, perhaps maybe retaining some equity is the best way to do that, so that they get a second bite at the apple, because the business may need to grow to actually sustain that valuation. But then you have to think about what's fair and what the contributions to growth would be from the buyer and the seller specifically. So all nuanced conversations. In addition, the valuation method will deeply impact the purchase price negotiations and structure. Now, most of the time, the valuation is going to be coming from the buyer and their particular methods based on the investors that they have, the lenders that they have, and how they can make this economic picture make sense post-closing, so that they're able to repay their debt, able to fund growth, able to pay themselves. So all of those are really important. There's different approaches. I'll go over them super quickly, whether it be asset-based approaches, valuing the tangible assets of the business. We're going to talk in our next episode about how asset-heavy businesses may be subject to valuations and appraisals through the lending process. So this is important to understand if there are asset-heavy businesses, how that determines valuation. And also, one of the elements that most people don't negotiate until very late in the transaction is purchase price allocation. How much of the purchase price is allocated to assets versus intangibles or real estate or anything else like that. And that's important because that does have tax consequences to both the buyer and the seller. So while it's a conversation that most people leave late into the conversation, if you can start having those conversations with your accountant as early as possible, it will benefit you both to be on the same page as to how you are allocating the purchase price. In addition, there are income-based methods. This is a lot of what I was talking about with the multiple of sellers' discretionary earnings or revenue or EBITDA. So those are going to generally try to analyze the future earning potential of the business. And then there's going to be differences between where the company is in its stage. Your typical ETA is going to be a very different valuation structure than something in a tech startup space where it's more looking for venture capital. So very different types of valuation depending on who's investing, what their ideas are, what their premises are for their investing, what the financing sources are, expectations post-closing. And then, of course, market conditions will influence valuation methods as well. In a really bull market, you're going to get higher valuations than you will in a bear market. That's just typical economics. So let's talk a little bit more, like we did, about those purchase price adjustments and variabilities. So with respect to an earnout or variable seller note, they're the inverse of each other. An earnout is where you have a base fixed amount that the seller will get at closing, and then they can earn more over time based on the typically financial performance of the business post-closing. Whereas a variable seller note is the reverse. So you have basically the maxed out amount, and it will be taken away if certain economic metrics aren't hit post-closing. The psychology of that is very different. The mechanism are the exact inverse. It's really just the opposite, because in SBA loans, you can't do an earnout. So it's the ability to create that. Obviously, that has a very different psychological impact on the buyer and seller, but mechanically, they're the mirror of each other, intended to be the mirror of each other. Of course, you can structure any deal any way that you want. That's the general structure. So those are generally going to be determined over a 12 to 18 month period. You typically don't see much beyond 2 years. Sometimes you do see 3 years, but that's really pushing it. And it's generally not going to be in an SBA situation, because your ability to include that variability is going to be tied to how long the seller is involved post-closing and how they can directly influence and impact that. They're not going to be as comfortable, but a seller may still accept variability if they're not involved, but may have lower tolerance for variability if they're not involved and can't influence the success. Whereas if they're able to be involved 3 to 5 years post-closing, because you don't have the SBA limitations of a 12-year maximum, then usually you can include it further. So you can always agree to whatever you want to agree to. I'm just trying to share some market typical terms that we would see. And so it needs to be very clear what those determinations and mechanisms and calculations are, because the last thing that you want when you're introducing variability into the purchase price determination is a lawsuit over it. That's why we usually use revenue or very, very clear mechanisms. EBITDA is used in bigger deals when you're talking about $10 million, $15 million plus. But that's typically only when the business is already using EBITDA calculations pre-closing, GAAP financials that are usually audited or something like that. So you're not generally going to see an earnout based on EBITDA in a sub $10 million deals, because they're typically not calculating EBITDA pre-closing. They may not have GAAP financials. So you have a much higher likelihood of that being litigated in the future. And that is not what we want to create. We want to create a positive working environment for both the buyer and the seller. So when you don't have GAAP financials, use a metric that's very easy to understand, such as revenue. And that's not going to be something that would be accusatory one way or the other, or, you shouldn't be taking these expenses, or these expenses are growth oriented and that's not what we agreed upon, or something like that. So having those as easy to facilitate and operate and not litigate in the future is the goal. And then you typically also have other types of adjustments, such as working capital adjustment, net debt considerations, other capital expenditure adjustments, whether that be add backs or something like that. So with working capital adjustments, like I mentioned, it's current assets less current liabilities, and what you have in that mechanism. Typically, it's based on historicals, and it's the function of cash flow within the business. So it is the current assets being the accounts receivable, inventory, cash of the business, current liabilities being accounts payable, and likewise. You also have complexity in this, in that some businesses actually make money before they spend money. Essentially, a lot of that being in the construction space and whatnot, they may actually have negative working capital that you need to think of. So In the letter of intent stage, most parties won't have this amount of financial due diligence completed to be able to know what the working capital needs are of the business. That's something that you typically would do with your financial expert in your due diligence period. So your typical LOI would include a normalized working capital based on trailing 12 months, or if they're experiencing recent tremendous growth so that 12 months wouldn't be reflective, you may have it based on 3 or 6 months. Now, if you have highly cyclical or seasonal businesses, take that into consideration. But essentially what a working capital adjustment will do is it will say this target working capital is the amount of working capital that's needed in the business. That's the engine. And if you have more working capital in the business than that, either the purchase price is adjusted upward or the cash is equivalent to the difference between the two will be taken out of the business prior to closing, so that at closing it has this amount, which we agree is fundamental to the picture of the entire purchase price. A lot of the time, sellers will want to keep accounts receivable because they've done the work for that. Totally fine if they take accounts payable related to that work too. So, it's not necessarily one party winning over the other working capital. It is just what is fair between the parties. And that's our true approach to how we represent clients. And then the true up is where, depending on the complexity of the business, the amount of transactions that are occurring on a daily basis, sometimes it's easy to start closing the books on a monthly basis leading up to closing. And in the couple weeks leading up to closing, you might close the books on a weekly basis or something like that, so that it's easy to close the books on the day of closing and have a complete working capital adjustment and true up on the day of closing. Certain lenders require that. Certain businesses, it's easy to do that. Other businesses are more complex and you cannot close the business on a weekly basis, or you cannot close the business with reasonable certainty of what the actual working capital will be on the day of closing. And so what you need to do is have a true up that's going to be 30 days or 60 days post-closing, sometimes up to 90 days post-closing. But remember, with that working capital true up, the more amount of time that's necessary post-closing to true it up, that may directly impact the amount of capital that the buyer has post-closing to pay bills and to pay, payroll and all of those things. So it's important to think of the actual consequences of these terms that we're negotiating. I think that's really important. That's why I like to put in there that instead of the purchase price being increased, that the cash will be distributed prior to closing. It's something that a lot of people don't think about, but most of the time the buyer wouldn't be in a position to pay more than they have planned with their lender and investors to pay. So we need to think creatively about not just how these are typically drafted, but actually what makes sense in the practicality of the business post-closing. And then other impacts are how we can minimize disputes. So we always have a dispute resolution in there, sending it out to independent accountants, how that's going to be determined, how the final numbers are going to be determined. So important. You may see a page, 2 or 3 page long working capital adjustment provision. Now, 3-page long working capital provision is probably going to be more along the lines of a 10 or 15, $20 million deal where it's really significant. You're probably going to see most deals below $5 million have a 1 or so page working capital provision. But don't be afraid of them. The more clarity that you have, the more easy it is for the businesses and buyer and seller to work through this post-closing. And then net debt consideration. So if the buyer is taking on debt of the seller, that may reduce the cash paid at closing. If debt that's going to be paid off at closing, that's something the seller needs to be thinking about. So overall, what is the debt picture? And sometimes it is beneficial for the buyer to assume debt of the seller for a few different reasons. First off, beautiful time when we had low interest rates. That can be a tremendous savings for the buyer where you're able to save on structure. Other instances are where it would be really hard to replace that debt, especially in a quick manner. In addition, if that debt is a natural part of the business, such as loans or auto loans or something like that, that would really make sense for the buyer to assume. And sometimes that's accounts payable or credit from vendors or whatnot. So credit from vendors can be really hard to replace. So all of those elements are going to determine those conversations. And then capital expenditures, whether there's add backs, whether those are repeating things, salaries taken from the seller, potentially their family as well. All of those add backs may also impact the purchase price. Unlock the power of in-house legal expertise at a fraction of the cost with Legal Foundations. Gain immediate access to a comprehensive legal crash course for business, a rich library of on-demand video legal support, and the opportunity to apply for group consulting with Laura DiFrancesco as your legal mentor. Whether you're starting up or scaling your business, Legal Foundations has everything you need instantly available. Join now and position your business for success. Visit lauradifrancesco.co/the-shop for more information. So anything can be as complex or as simple as you would like it to be. Don't overcomplicate it. Don't undersimplify it. I think it's important to have a really good place where you meet in the middle that's reasonable, and your attorney will help you understand what's market for this business size, for this transaction size. With that said, let's talk about seller notes. Seller notes have a lot of different elements to them that will impact your economics of your transaction incredibly. The benefit of the seller note to the seller, as I mentioned, is that they can defer income, and so they can defer tax consequences of the transaction. This can be incredible. A lot of sellers look for the deferred trust type of savings, which can be one way of saving. Seller note is another way of saving. And when done well, can be a great mechanism. With respect to buyers, seller notes can be a great opportunity to reduce your cost of capital, reduce your debt payments post-closing, because it may be more favorable terms than SBA or commercial lending. So the core elements that you'll be negotiating that we like to make sure are in the letter of intent are what the interest rate is, which may be market or relationship based or below basically what they could make in commercial real estate or something like that. So typically I see it being 2 to 3 basis points below your typical interest rates that you get at a commercial lender. Sometimes it's more than that, sometimes it's less, sometimes it's more than commercial lender. So it just depends on the relationship, the security, most importantly, that the seller would have that it will be repaid. Payment terms, the repayment schedule, whether it's fully amortized, meaning all interest and principal are paid before the maturity date with the last payment on the maturity date, or whether there's a balloon payment where fixed amounts of principal and or interest are paid and a balloon at year 5 or year 7. Typically, you're going to see something between a 5 to 10 year seller note. That may include 2 years on standby if the buyer is looking to use the seller note as their equity injection with the SBA loan. That is something that really should be considered at the LOI stage, because if it's not amenable at that time, it's really hard to get that included later on, because it is a material difference and the seller would be reducing their expectations of income post-closing. In addition, it's important to put in the LOI that the terms of the seller note, if you do have a primary lender, are subject to approval by the primary lender, because then it creates an expectation from both parties that this is what we're saying, but we do need our lender to underwrite it and agree to this as well, since they are going to be receiving debt payments also. And then what the interest rate is it interest only payments for a certain period of time? Is it on full standby for a certain period of time? When do principal payments start? All of those. Also, if there's any sort of hold on any payments, if there's variability to payments, if there's a variable seller note or anything like that, all of that needs to be included in here, as well as the security. So the security is what capital requirements does the seller need to feel comfortable loaning this amount? The seller is a lender. I'm sure they're going to require some amount of collateral. It depends on what it is. It may be a second priority collateral requirement, but they may still have collateral requirements. That may be that they have a security in the assets of the business, which is going to be a security agreement, in the stock of the business, which is going to be a pledge agreement, or a personal guarantee, which of course will guarantee the loan is paid by the individual if it's not paid by the business. So all of those are negotiable. Most of the time you're going to see some sort of security agreement. Some of the time you're going to see a pledge agreement, and then more rarely you'll see a personal guarantee. It depends on how much the seller note is, what a percentage of the purchase price that is, and whether they're the primary or secondary lender. Sometimes personal guarantees in a secondary lender situation don't really have all that much weight, so they may not be negotiated, but it is all about leverage and who has the negotiation leverage and how you work through these different economic elements as a whole to negotiate what works for both parties. Most people forget about the tax consequences. One more thing I want to say about the seller note is to make sure to also include if there will be set-offs and clawbacks. Basically, if you're the buyer and looking to have your seller note be an opportunity to offset risks from indemnification obligations of the seller, make sure that those are in there too. With that said, let's talk about tax consequences. A lot of people want to have a conversation with buyer and seller 2-3 months into having an LOI signed that they're finally going to be talking about how the deal will be taxed. And that can have tens of thousands of dollars, if not hundreds of thousands of dollars of economic impacts to the parties that it is way too late in the deal to be talking about. These conversations need to be had at the LOI stage or immediately thereafter. This is an element that both parties should be talking to their accountant and their attorney with immediately as soon as the deal conversations are being started, because how the tax of a transaction works is that there is an inverse relationship generally between what the seller pays in taxes versus what the buyer pays in taxes. That may be immediate, or it may be something such as the step up in basis that a seller may receive and the tax benefits that they may receive by having a stock deal, for instance, taxed as an asset deal. Generally, if it's taxed as an asset deal, it's going to be better for the buyer. Generally, if it's taxed as a stock deal, it's going to be better for the seller. But the parties can elect to tax the transaction differently by making various tax elections, 338H10, 336E, I think there's also maybe a 336G. So all of those have different requirements for what must be met to actually qualify for that tax election. And then, of course, the parties also need to discuss it. Most of the time, though, people don't understand that you can't just say that I want a asset election, a 338H10 or something like that, because I think it will benefit me. That doesn't work. You need to be able to quantify it with your accountant to make sure you understand what the tax consequences are and whether it's even worth it. Because if it's an asset light business, it may not be worth it. Or if all of the assets have been depreciated, it may not have the same tax benefits that you think it will. And you don't want to blow up a deal over $5,000 of savings, right? So you really have to understand meaningfully what the tax consequences are. That's why you need to have those conversations as early as possible with your accountant and attorney to be talking through the tax elements. In addition to the tax treatment, whether it's treated as a stock purchase or an asset purchase, as I mentioned before, that purchase price allocation is something that a lot of people leave until the last minute to discuss, and it has an economic impact. It can have a very significant economic impact. What's important is to understand what the quantity and amount of that economic impact is and how meaningful it is to the parties, because you don't want to be going down rabbit holes, wasting legal dollars, wasting time, frustrating the parties if you're talking about $5,000. That's not meaningful in a $5 million deal. So you have to understand the quantity of the impact before you know how you want to negotiate it. And then accounting aspects that are really important too is understanding whether the financial statements have been provided are based on historical financial practices of the business. Are they cash accounting? Are they accrual-based accounting? Are they GAAP-based? What are these? What are we looking at? So when you're thinking about understanding the financials, that's one of the big questions to ask, because if you don't know what you're looking at, you don't know how meaningful it is. And it's not often, but sometimes you will see businesses that not correctly flip constantly between cash and accrual-based accounting because they don't know what they're doing. So you really need to understand what the financials are and how that impacts you, because it will have an impact. Now that we've talked about those, let's talk about negotiation strategies. As I mentioned, there is leverage that the parties have one to another. You have to understand what that negotiation leverage is, who has more leverage in the negotiations between the parties, and how can you use that to your benefit to get the deal points that you want that are important to you, and how can you use that to understand what is important to the other party and how you can create an entire picture of deal terms that is mutually acceptable. That is what your lawyer specializes in. That's what we specialize at Dean Street Law and are happy to help you with. So different things that will impact that leverage is market conditions. Is it a bear market? Is it a bull market? Is it highly competitive? Is it not? And then also the company specific and the negotiation specific factors. Is it a competitive situation where it's out to auction or there's 5 private equity firms and you bidding on it? Or is it something where you've built a relationship and found an off-deal market and have more flexibility and ability to structure the deal terms in a way that makes sense, and you have more time to do that as well? And then also, what are the company-specific factors that are going to impact it? What are the company's strengths? Are they absolutely killing it the last 10 years and just continuing growth and growth and growth? Or are there a lot of risks in the business that need to be addressed in some way through value? And then how can you use what's on the table, all of the chips and pieces on the table, to move forward your most important deal terms in the business? And how can you leverage that negotiation leverage that you already have in an ethical, compassionate, friendly deal-making way? There is so much that you can do that's ethical, that's friendly, that will have a positive relationship with you. I find oftentimes that the people who are the worst to deal with are actually not successful in the long run. If you can't see someone else's perspective, if you can't listen to them, if you can't view it from their viewpoint and find mutually beneficial solutions, the likelihood that you'll be successful in this deal and future deals is diminishing by the minute. So you really have to find ways to see the other person's point of view, to address their concerns, to work through your concerns as well, and ultimately land on something that's fair. The goal should be to find something that's fair, mutually beneficial, win-win-win, all across the board. That's the goal. And then what are some common issues and mistakes that I see is not documenting this correctly, whether it be at the LOI stage or having an attorney that doesn't have M&A experience. If you can agree to all of these things, but they're not documented so that the documents actually say what you think they say, or that the documents actually reflect practically what you need to happen, such as a buyer can't really just increase the purchase price by $2 million if there's $2 million of excess working capital for some reason. So also that conversation about how much of that working capital is in cash versus not. You actually need a certain amount of cash in your cash flow of your business to sustain the business. So if your attorney doesn't have the experience that you need, or you're skimping or you're cutting costs or whatnot, it is extremely detrimental to overall your economics of the deal, actually, because if you win on structure, that directly impacts your bottom line. And then what negotiation tactics often backfire is when people get overly emotional, when people make it one person versus the other, whereas when someone's able to ask questions and be a good listener and really understand deeper motivations, not just the surface level answers, but getting to the deep motivations about what the parties are concerned about, that's where you find mutually beneficial solutions. But where you get ego involved, that deteriorates conversations immediately. And also when things are retraded. So when these important economic considerations aren't discussed early on or are unnecessarily retraded, yes, if the financials of the business tank in the 2 to 3 months that you're negotiating the purchase agreement, yes, that will impact value. But due diligence is meant to be confirmatory, and it's on the buyer to make sure that they understand the full economic picture of the transaction and are transparent with that, and both parties are aligned, and that neither party is retrading. And this is not just a buyer issue, this is also a seller issue too. Sometimes it happens when a primary operator is operating the business and talking about selling the business, and they have an expectation of what they want to get out of a business, and then the spouse has more of a minority part but a deep influence, and then perhaps the spouse wants more or something like that, or maybe the seller then starts talking to advisors and advisors start saying that they need more or something like that, and then they want to retrade. That will deteriorate trust in both parties and will quickly kill a deal. And then overall, the goals with the discussions around the different economic elements are going to be deeply impacted by risk, and risk management is a key element to manage throughout this process to be able to mitigate risks in ways that don't necessarily have to solely rely on the economic elements of the deal. So how else can you mitigate risk in a business? Representations and warranties, indemnification, and other types of protections that we've discussed, such as set-off and clawback provisions. Those are just a couple of many different risk mitigation strategies. There's also escrows, holdbacks, purchase price adjustments, as we discussed. So those are just a couple of different ways where you don't have to put 100% of the risk mitigation on the economic aspects of the deal, but how you can mitigate them in other ways too, so that you can get to agreement on these deal points and move forward with buying the business, selling the business, successfully moving forward with your life in one way or another. At Dean Street Law, this is what we specialize in. We have a very fair, good perspective on this structure overall, whether we're representing buyers or sellers. If you'd like to discuss your deal, we would love to talk to you. You can schedule a consultation call through the link in our show notes. Of course, be sure to subscribe, leave us a 5-star review. Leave us a comment on our podcast. You can do that on Spotify now. And if you're a buyer, be sure to join the wait list for my book. My new book is coming out, Entrepreneurship Through Acquisition, a legal guide to buying a small business. If you're on the buy side or if you're on the sell side and want to know what buyers think about, this is an incredible opportunity to learn so much about the legal aspects of buying a business. It deeply impacts your success overall and can really strengthen your position and your deal-making skills. So would love for you to join our wait list. It will be launching soon, and you can get the first chapter by signing up for the wait list. So I'm really, really excited. The link is in our show notes. Be sure to tag me on social media, share with a friend, whether it be the book or otherwise the podcast. Share with a friend that it may support. Thank you so much for joining us on this episode of Deal Making with Laura DiFrancesco. I look forward to seeing you in the next. Cheers and happy deal making. Thank you so much for joining us on this episode of the Dealmaking with Laura DiFrancesco podcast. I hope you found today's discussion insightful and that it brought you one step closer to mastering the art of mergers and acquisitions. If you enjoyed this episode, please be sure to follow and subscribe to Dealmaking with Laura DiFrancesco on your favorite podcast platform so you never miss an episode. And if you found value in our discussion, please leave a 5-star review. It would mean the world to us, and share this podcast with your network, friends, and colleagues. For more in-depth resources, be sure to visit our website, deanstreetlaw.com, where you can find articles, guides, and more information on our services. Don't forget to follow us on social media for the latest episodes, updates, tips, and exclusive content. You can find us on LinkedIn, search Funder, at LMDFrancesco on X, and at Dean Street Law on Instagram. Join us on our next episode where we'll explore more deal-making insights. Cheers and happy deal-making.